Institutions are rebalancing their portfolios, and honestly, so should we. This is something I've been talking about on the channel for almost a month now, taking profits on stretched positions, trimming short term trades, and building cash to take advantage of the pullback we have been expecting. And right on cue, one of the biggest signals just came from Tom Lee's team, the managers behind the Granny Shots ETF, which controls over $3.6 billion in assets. They made several meaningful changes in their portfolio, and whenever institutions of that size start repositioning, it's always worth paying attention. In this video, I'm going to walk you through the stocks that they removed, the stocks they have added, and what my own valuation model shows for each. I'll also share whether I personally think these names make sense for my portfolio and what message these moves are sending about where the market might be headed. But before we break down on the individual stocks, let me address what's happening in the broader market. We are going through a pullback right now, and I know it doesn't feel good. It never does. But these kind of corrections are completely normal. And in my view, this still looks like a short term pullback. Personally, I actually want to see SPY drop below 650. That would be a much healthier reset and could set us up for a strong year end rally. So, hang in there, stay patient, and use this volatility strategically rather than emotionally. All right, now let's get into these portfolio changes. Tom Lee's team removed four stocks, and they are Garmin, Live Nation, Oracle, and Willis Tower Watson. My model actually supports most of these decisions. Garmin shows only about 15% upside over the next 5 years and is overvalued based on a negative 1 year projection. Live Nation has roughly 49% upside, which is fine, but again, not compelling. Oracle shows a very strong long term upside on paper, but the issue is their cloud demand narrative didn't match reality. They don't have many major enterprise customers outside of OpenAI, which explains the recent sell off. And Willis Tower Watson shows solid long term potential, but again, it's not a company I follow closely enough to comment on with confidence. Now, let's talk about what they have added. They have added DRE, PNC Financial, SOFI, and TJX. This is where things get interesting because three of the four additions, DRE, PNC, and TJX, are all conservative, slow growth, stable companies. That's a big shift. It tells me institutions are preparing for volatility and choosing to hedge rather than doubling down on high beta growth stocks. DRE, for example, shows only around 50% upside over the next 5 years in my model. It's a classical cyclical company with heavy exposure to agriculture, and revenues have been declining for 7 straight quarters. The stock has also been flat for nearly a year now, and Morningstar estimates fair value at around $550. It's a solid company, but not one I'd personally be buying during a pullback. I'd rather accumulate ETFs or my highest conviction growth names, which has better upside. And the next one is PNC Financial, which is also similar. It's stable, diversified, and they are expanding aggressively through the first bank acquisition and by opening over 200 branches by 2029. My model shows around 55% upside in 5 years. This is good, but again, not explosive. Low volatility, slow growth, and safe. That's exactly what institutions lean into during uncertain market conditions. Then we have SOFI. This one stands out because my model shows 229% upside over 5 years. But don't forget, SOFI has already delivered enormous returns. I sold half of my positions few months ago for about 110% profit, and I'm up over 200 profit on the remaining shares. Even those who bought after my earlier analysis should be sitting on roughly 150% gains. Hedge funds have been accumulating recently, which tells me the long term story is still strong. I'm holding what I have for at least another year. And finally, we have TJX. It's an off price retail giant. It has TJ Maxx, Marshalls, Home Goods, Winners, TK Maxx, all under the same company. It's stable and consistent, but my model shows only around 59% upside in 5 years. Nothing wrong with that, but nothing compelling either. It's another safe, slow growth name, again confirming that institutions are rotating into stability. So, what does all of this mean? To me, these moves send a very clear message. Even bullish institutional investors are preparing for a period of uncertainty, taking profits in overextended names and allocating more capital toward conservative, low volatility companies. And this is exactly why I always say retail investors should watch institutional behavior. It doesn't tell us everything, but it reveals the posture of the smartest money in the market. Personally, I'm sticking to my plan. I'll continue using this pullback to accumulate ETFs, high conviction long term positions, and stocks with strong asymmetric upside based on my model. But I won't chase slow cyclicals here, not when the market is still recalibrating. Let me know what you think about these changes in Granny Shots ETF. Do any of these additions fit your strategy, or do you prefer staying focused on high conviction names and ETFs like I do? I'd love to hear your thoughts in the comments. And as always, thanks for watching. Until next time, stay patient, stay focused, and invest mindfully.